We're going to talk about dangerous tax strategies. I'm not going to list out a bunch of dangerous tax strategies, but what I am going to do is methodically walk through a way for you to analyze what you see on YouTube or any tax strategies that somebody might tell you about. I'm going to give you a methodology that you can use to say, okay, is this a legitimate tax strategy? Is this really going to work? Or is there something really fishy about it and I need to talk to a tax professional regarding this strategy? Now, I always recommend when you're talking about taxes, you hire a competent tax professional to help you with that. But again, this is going to be I'm going to give you some basic things to look for and things to consider with any tax strategy that you see. Okay. So let's lay the groundwork for all tax strategies, for all taxes. And I've mentioned this before, but I'm going to continue to mention it. We got to lay the groundwork for all the things related to taxes. So number one, personal expenses are not tax deductible unless Congress writes a law that allows a personal expense to be tax deductible. What is an example of that? Childcare. You can get a child care tax credit, or you can get a deduction for child care expenses. That is one situation where a personal expense was made legally deductible. Or if you own a home, you can write off your property tax or the interest you pay on your mortgage. That is what a personal expense that has now become tax deductible. So if you don't own a business, if you don't invest in real estate, or you don't do something outside of personal expenses, you're going to be very limited on what you can do from a tax planning perspective, meaning cutting your taxes when you file your tax return. So you need to have a business generally to completely open up the tax code, or you need to have real estate to completely open up the tax code. Now, for something to be considered a business, you must have a profit motive. So I start a business and my goal is to make more money than I spend. I invest $100 in advertising. I have an expectation to get at least $200 back in revenue for the $100 that I spend in advertising. So businesses and real estate investments, they got to have a profit motive. This is the backbone of being able to take business deductions and to being able to take deductions for the expenses in your rental real estate or in your real estate investments. Well, you can deduct anything that is an ordinary and necessary expense for that business. And I've talked about this in previous videos. I'll leave the link in the description where we go into ordinary and necessary expense. But very quickly, if it is something that you need in order to make a profit or to run that business, 99% of the time you're going to be able to take the deduction for it. I hire an employee. Well, I need an employee to grow because I've got more revenue and I've got more clients. That's going to be an ordinary necessary expense. Advertising. Nearly all businesses try to advertise. That's an ordinary and necessary expense for businesses. If I want to grow, I got to pay for some advertising. So I'm laying this groundwork because you can take this framework and now you can start analyzing at a high level some of the strategies that you hear. Now, we've laid the groundwork for that. So here is one of the strategies that you hear a lot. It's very popular. And what is that strategy? It is to pay your kids to be in your business. It's a legit strategy. You can do it as long as you pay your kids to do something in the business that is appropriate. For example, you can't pay your 5-year-old $50 an hour to shred papers. I have a client who has confidential documents and he produces those papers. And instead of paying a company to shred it, he just pays his daughter to shred the papers. I believe she's 8. He pays her about $15 an hour. That's reasonable. That makes sense. He would pay someone if he went out into the marketplace and was going to pay an admin or an administrative assistant or whoever. You would pay them around anywhere from minimum wage to $15 an hour. And so that's a legitimate strategy that you can use. Here's where the problem comes into play. Now, when you are a sole proprietor, that means you are the only person that owns it. So that means a single member LLC is a disregarded entity. It gets taxed as a sole proprietor. Or you have a partnership where both spouses are working in the partnership. So they both need to be 100% owner of that partnership. So these are the situations where if you employ your child and they are under 18, you don't have to withhold or collect Social Security tax or Medicare tax. Man, that's 15.3% that you don't have to pay an employee in your business. So that is an incentive to hire your kids to work in your business because you can pay them and you can get a tax deduction for it. So how would you use that strategy? Well, you pay your kids to work, anywhere from 20 to 40 hours a week. You would track their time just like you would any other employee, and you would give them responsibilities that you would give any other employee in your business. And now anything that you pay them, you're going to be able to write it off because it's an ordinary necessary expense for the business, and you're having them do things any other employee would do. And as long as you don't pay them something crazy that's out of market, you're not going to have any issues with the IRS related to that. Where does the problem come? The problem comes in when you have an S corp that's 100% owned by one of the parents, and then they try to employ their child in that S corp. So if you have an S corporation or a C corporation and you pay your kids through that corporation, you must withhold federal income tax and you must collect Social Security, Medicare, FUTA, and in some states, FUTA is federal unemployment tax, or SUTA, which is state unemployment tax. So in some states, you must collect that as well. Oh, man, how are we going to get around this? How do we get around this? Oh, I know. We create a business that isn't a corporation. I don't know. I'll create maybe a family management company. And the sole purpose of that family management company is to get around this rule. I don't want to collect Social Security and Medicare for my kids if I don't have to. Why don't I create a company and its only purpose is to avoid this rule? Here's where you can run into problem related to that. There are two concepts you have to understand about the tax law. One of them is the economic substance rule. And what is the economic substance rule? It says, hey, you can't create a strategy whose sole purpose is to eliminate taxes. That's why I laid the groundwork in the very beginning for this. Personal expenses are not deductible. You got to have a profit motive in your business, in your trade or business, and you can write off ordinary and necessary expenses. So paying your kids, that's an ordinary necessary expense. However, creating another entity whose only purpose is to pay your kids, that violates this rule. It does, because so what will end up happening is if this goes to court, understanding that there's a thing called economic substance, what the courts will do is they will do what's called a step transaction. They will take the step transaction doctrine. And what does that mean? What they're going to do is they're going to walk through the transaction and say, if I were to just walk through this and I was to start peeling back the layers of this transaction, if the end result of us peeling back these layers is the only reason this transaction exists is to get around the tax code, then the whole thing just blows up in your face. you're going to have to end up paying penalties and interest because you didn't collect Social Security and Medicare like you should have. You didn't collect withholdings. You probably didn't file your 941s and your 940. It just starts snowballing and snowballing. So the step transaction doctrine basically says, look, we're going to look at the substance of what happened over the form of what happened. And so you can take this approach for practically anything you hear that's out, any tax strategy you hear out there, any tax strategies here on YouTube, any tax strategy, your friend comes up to you and says, hey, I got this great idea of what I heard from this CPA say or this person tell me, and they file this claim all the time and they don't ever pay any taxes. These doctrines exist where in the tax court, I always reiterate, or at least I try to in every video, you need to assume that your tax return is going to end up in court. And these are the tools that the courts are going to use to decide who's going to win when you go to tax court. So there are some dangerous strategies that are out there. They are telling you to execute things. I call it audit lottery. What is audit lottery? They basically say, hey, look, if you don't get audited, it's not going to matter, and you kind of got away with it. That's not a way that I do things in my firm. The way I do things is say, there are so many things, there are so many strategies that exist, and you can do them the right way without having to make up these crazy, different machinations around the tax law. There's enough out there for you to do it. There's ways for you to do the thing. There are ways for you to execute strategies and save as much in taxes. And in some instances, you may be able to wipe out your taxes to zero. So remember, economic substance, step transaction doctrine. When you enter into a business, yes, you want to be able to reduce your taxes, but you want to do things in such a way that its primary goal is what most businesses want to do. What most investments are made for is to give you more money than what you put in it. And then the secondary benefit will be you can save your money in taxes if there's a way we can use the law to do that.